Sanfilippo Son just reported their Q4 2026 earnings, and they missed consensus badly on the bottom line despite a revenue beat. EPS came in at 71 cents.
Right, missing the $1.17 estimate by a massive 46 cents.
Exactly, and revenue actually hit $280.43 million, which beat the $274.87 million estimate, up 4.2%.
Yeah, but management didn't even provide quantitative fiscal 27 guidance. They just gave, qualitative strategic priorities.
And the stock reacted instantly. I mean, it gapped down, plunging 8.22% in after hours, trading to $74.62.
That 8% drop really just perfectly illustrates the ruthless math of public markets right now. Top-line revenue growth here was completely overshadowed by severe bottom-line contraction.
Yeah, because gross margin compressed sharply, right?
Dropping to 15.7% from 18.1% a year ago, it's a huge hit.
It's like a popular restaurant that is packed with customers, but they are losing money on every single plate because the ingredients suddenly got too expensive. How much of this margin compression is a one-off event versus something systemic?
Well, the systemic issue is tied to that massive new contract manufacturing customer they landed. You would think more volume means better economies of scale, but...
Right. It sounds like trying to upgrade your car's engine while you're driving 70 miles an hour down the highway. Why is the friction of bringing that volume online eating up all the profits?
Because you're hitting what we call the growth trap. When you onboard a massive new customer, you don't instantly achieve economies of scale. First, you hit severe manufacturing inefficiencies.
Like actual downtime to retool the factory lines.
Exactly. You have the trial and error of dialing in new packaging specs and the cost of training your staff to handle entirely different product runs. That friction dragged down their margins, and that was compounded by elevated freight and raw material costs across the board.
And they had a one-off hit in the mix, too, a $2.7 million charge.
Right. That was tied to a third-party dry milk powder recall, which they use in some of their product steering. But that's a singular, isolated event. The margin compression from scaling operations, that is the systemic issue.
But despite all those bottlenecks on the factory floor, they actually are pumping out more product than before. Company-wide sales volume returned to growth, up 1.4%.
Which is huge because it snaps a brutal streak of 5 consecutive quarters of volume decline. The demand is definitely there.
So breaking down those channels, consumer volume rose 0.8%.
Yeah, driven mostly by their private label business. And that was actually strong enough to offset the negative impact of a totally separate product issue they had earlier.
The Southern Style Nuts Hunter mix recall, right?
Right. Meanwhile, contract manufacturing surged 12.6%, which is the direct result of that massive new customer coming online.
The only drag was the commercial segment, which fell 5.4%. The report cited the timing of peanut crushing stock sales. What exactly is happening there?
Essentially, that segment involves selling raw, crushed peanuts in bulk to other food manufacturers. The timing of those bulk commodity sales is just highly volatile quarter to quarter.
So a 5% drop there is mostly a timing mismatch in bulk orders.
Exactly, rather than a structural failure in the underlying demand.
If you're looking at this stock, you have to ask yourself how management is navigating all this operational friction, especially with a major leadership change looming.
Right. CEO Jeffrey Sanfilippo is transitioning to executive chairman in October,
handing the reins to the current COO, Jasper Sanfilippo. Is this executive transition strategically timed to oversee the new $300 million bar capacity expansion at their Elgin plant?
The one targeted for Q2 of fiscal 27?
Yeah.
It looks very deliberate. As the chief operating officer, Jasper is intimately familiar with the exact manufacturing hurdles we've been talking about.
So when you are pouring $300 million into a massive physical plant expansion, you need an operations expert at the helm.
To ensure that new capacity actually becomes profitable, rather than just creating a bigger, more expensive bottleneck. Landing big fish and expanding capacity requires massive upfront capital.
Right.
It's a textbook lesson that scaling up will absolutely break your margins in the short term if the cost of retooling outpaces your immediate cash flow.
Which leaves you with a final thought to ponder as we look at their next fiscal year. Will this aggressive capacity expansion and the onboarding of massive new contract customers serve as a long-term growth catalyst once the engine is fully rebuilt?
Or is JBSS just creating more near-term manufacturing bottlenecks that will continue to chew up their bottom line?
Make sure to follow the show for your daily earnings coverage.